Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser of Victory Fiduciary, and today we have a couple things we want to get into. Number one, kind of talking about the tone of the Federal Reserve. So if you tuned in with us last month, you know that we were waiting to see what the Federal Reserve stance was going to be. We expected to see an additional rate hike, which did come to fruition, which again was not surprising, was expected. Markets had basically priced those movements in, and so it was an interesting tone the last time that the Federal Reserve spoke, where Jerome Powell didn't actually commit to it, but definitely hinted to the fact that we could be entering into a season of a rate hike pause. So, you know, we've been under a very aggressive increase in rate hikes over the past year, which has had a lot of consequences on just kind of general cost of living, cost of borrowing. We've talked about how mortgage rates have spiked to levels that we haven't seen really since the early 2000s. At times we've seen some of the most significant increases kind of month over month, certainly in the last 10 years. And so we're kind of now in this space of maybe we can kind of I don't think that we're at a point where they'll be able to cut rates anytime soon, but I think it is realistic that maybe we're in a situation where again the Federal Reserve can just kind of stand back and wait and kind of hold where we are. So I thought that it would be interesting to kind of talk about not just kind of where we are with markets right now, but kind of how markets have reacted in the past once we've gotten past rate hikes and kind of entered into the pause and then the eventual decrease in rates and kind of what markets have done. So we're going to get into that as well. So we have a lot of good stuff for today. And so number one, just the S&P 500, just kind of looking at moves from the beginning of the year till now. So we've seen, obviously we've had a nice kind of run from the beginning of the year to where we ended. And so we have our long and short term moving averages. We are still well above these areas, which act as nice levels of support now for us, certainly. So these are encouraging charts to kind of look at to be above these moving averages. Relative strength is sitting at a 50, which means that not super overbought or oversold at this point, just kind of like in the middle, so things kind of go either way at this point. But something that I thought was really interesting is if you look at what the S&P has done, so this is going back from March 31st. March 31st, we closed at 4109, and then yesterday's close on the 16th was 4109. So we have gone absolutely nowhere on the S&P 500 since March 31st. We've seen just kind of some big runs up, some big drawdowns. So we've seen some increase in volatility over the past month and a half, but we haven't actually gone anywhere. So just thought it was kind of interesting movements to see, because sometimes, you know, day to day when you're looking at these things, you feel like there must have been big movements this way or big movements to the bottom. And certainly over the 6 weeks, we've literally traded sideways. Again, you know, not surprising. I think that, well, we call this consolidation when we look. So when we're trading within kind of narrow spears, both up and on the downside. And so I think that for markets, especially those that maybe kind of took early runs at the beginning of the year till now, you know, they may need to kind of cool off for a little while and to kind of trade in that consolidated pattern. If you read my blog, which if you're not getting my monthly blogs, you can go to our website. I'll show you that at the end. But in my blog, one of the areas that we just kind of talked about was, again, the idea of, you know, how far markets can go, especially under different rate hike circumstances. And so, again, the NASDAQ, so this is kind of our more tech-weighted index that has had a really substantial run, and even like since March has kind of had additional performance to the upside. So the NASDAQ certainly performing very well. Again, we are well above our 50-day and 200-day moving averages, which are bullish signals or, you know, positive encouraging signals for the index. And again, our RSI, or relative strength, sitting at 59, so a little more overbought than the S&P 500, but we're not really at those extreme levels by any means. So just found this website and think that it's really interesting. So if you're ever interested in what the actual real inflation numbers are day to day, Truflation, TRUflation is the website that where I was able to pull some of this data from, and this just shows from year over year what inflation has done. And so we have had a market drop off since last June where this starts, and so just kind of interesting numbers. So the government here is reporting that reported rate of inflation is 4.9, and then U.S. Truflation reported today's daily inflation rate at 3.36 and falling. So again, just kind of thought it was interesting to kind of see. So we have made progress when we look at actual inflation year over year. Now, I promised you that we were going to spend a few moments and discuss, hey, what happens after a rate hike if we look back at history. And so I would say that the news is very positive when we look to see what's happened in markets. So this would be 12 months once a rate hike cycle has officially ended. And so we don't know for sure if we can say that we're absolutely beginning this 12-month rate hike end. So we're just going to have to see how that plays out over the next few months. But once that has been confirmed, typically what we'll see is that in terms of regions, U.S. equities will return 20%, global equities will return typically on average 16%, and emerging markets 14%. And then when we look at size in terms of equities, mid caps outperform the other two areas at 23% performance, with large cap just behind at 20 and small cap at 19. And then regional bonds, looking at fixed income. So emerging markets typically is up around 22% for the year. U.S. bonds at 12, global bonds at 9. And then when we look at the different qualities, intermediate governments typically up 14, high yield 12, and then U.S. Treasuries up 10. So again, what this kind of shows is if we want to look back at history, what's happened during other rate hikes, we can kind of typically expect to see nice, strong, positive performance after those 12 months. So have we started that clock? We don't know for sure. History is certainly going to tell us, but if we are in a situation where the hikes have paused and then will eventually at some point begin to be brought back down, that tends to be very bullish forward looking for stock markets. So I thought that that was interesting. And so one last slide here, just looking at what fixed income has done. So you'll remember, so last year, fixed income was really a tough place to be. It really got hit hard. Anytime you're in a rising rate environment, you will expect for bonds to, especially for the short term, kind of take that on the chin. And we saw that play out because especially the longer duration bonds performed the worst because you could get shorter bonds paying higher yields. And so that's kind of how that works there. So right now, bonds they've done okay for the year to start, and so we have seen the inflation protected bonds up about 2.5% year to date, and then high yield short term duration up 1.8, and then the Vanguard total bond market index is up just marginally at 0.34. So again, they coming off of a year where they were decimated. We've seen some modest returns. I know us as a firm, we are looking to kind of toe the water back with fixed income, begin to add it in. We actually, we removed it very early when we saw kind of what inflation was doing. We knew with rate hikes, fixed income would typically have a poor favorability, at least for the short term. So we went to ultra short money market and stable value funds for our 401k participants, which wound up being smart moves. But for now, we are looking to see if it is appropriate to kind of begin to put our toes in the water with fixed income and begin to add that back to our portfolios. And so I promised you that if you have not been receiving my blogs, that you have the ability to go and pull all of them off. So at victoryfiduciary.com, right here, that's our website. If you ever have any questions about things that we discuss or topics that you're interested in, they're my favorite emails to get. So if you have a specific topic that you're like, hey, I'd really like to hear about this, just shoot me an email because I'll be sure to cover it in an upcoming video. If you have questions about your current portfolio, your allocations, if you just want to kind of have a second opinion, I'm always happy to help. and do that. So that's our contact information. And so otherwise, we thank you for joining us today. And again, we are cautiously optimistic that maybe we're at least in the midst of a rate hike pause, and so we're just going to have to kind of see how that plays out over the next months. We think inflation numbers look like they are finally beginning to quiet some, and again, which would have favorable implications for markets as well. So again, we'll just have to wait and see, but we thank you for joining us. We'll see you next month.